Hello everybody, I'm Alan Gelder, VP of Refining, Chemicals and Oil Markets for Wood Mackenzie. I'm here to provide you our outlook for oil, refining and chemicals as part of the MENA Energy Meet. COVID-19 has taken a huge toll on the global refining industry, as both refining runs and refining margins have collapsed. April 2020, oil demand had fallen by over 21 million barrels a day compared to 2019 levels. Refining runs did not collapse to the same degree, and so actually crude runs were lower globally in May than in April. Inventories built, and what that's resulted in is that refining margins have collapsed, as we show on the chart on the right-hand side, with showing only modest levels of recovery over recent weeks. But the impact of this is the profitability of the refining sector is very, very poor at present. Moving forwards, our expectation is that a vaccine becomes available end of Q1 into Q2 next year, and we get a strong economic rebound. Chart on the right-hand side shows our forecasts from earlier this year when we updated our long-term outlook. And the consequence of COVID-19 is actually a degree of economic scarring. So global GDP will still be below the pre-crisis trajectory in 2025. If we look at the chart on the right-hand side, what we're showing is our view of there is a degree of permanent loss of demand that the world is experiencing as a result of this pandemic. That is primarily in middle distillates through some diesel gas oil, but also jet kerosene, as we do not see jet kerosene returning to the demand levels we had pre-crisis as a result of change in mobility and change in business travel levels. So, impact of COVID-19 is the global economy has been scarred by the pandemic and the associated lockdowns. If we look longer term, we're confident that oil demand growth will return as populations rise, GDP recovers, and a growing degree of urbanization. However, we're embarking on an energy transition, and the impact of the energy transition through the electrification of vehicles is that global demand growth for gasoline, we think, peaks around about 2030. Global demand growth for diesel gas oil slows through improving energy efficiency and some penetration of fuel cell vehicles potentially at the end of the forecast period. Chart on the left-hand side shows that the key driver of oil demand growth from this period forwards is really petrochemical feedstocks. Even though we have the relative growth rate of petrochemicals weakening, so down to GDP parity levels rather than GDP plus in percentage terms, petrochemical feedstocks are the key source of oil demand growth going forwards. If we look at the chart on the right-hand side, what we're seeing is a shift in where that demand growth is expected. Pre-2020s, what we saw was key demand growth region was China. What we're expecting actually is that center of demand growth to move from China to India here on in, or particularly post-2025. We're expecting demand growth to continue within the Middle East, Africa, Latin America, but something of particular relevance to North African countries, North African players, is that we're expecting oil demand within Europe to continue to fall, and actually oil demand within North America to also fall from this point onwards as a result of the energy transition. So far we've talked about the impact of demand. The impact on supply for crude oil is actually far more significant. The drop in crude oil price has structurally reduced the number of upstream projects that are going to have their final investment decisions taken both this year and next. We see the impact of oil supply loss being far greater than the loss of oil demand. And what that does is it results in the oil price post 2025 in our current forecast being higher than our pre-crisis forecast. So what we see is a world in which oil demand and oil price recovers to the mid-70 levels by 2025. We had a period of weakness through to that as the OPEC Plus group tries to balance the market to supply sufficient volumes to satisfy demand growth. But once we've gone past that equilibrium point, which is 2022, 2023, then actually we expect the oil market to be tighter than we previously forecast. This is a benefit to the chemical sector within the Middle East, much of which is gas-based, competing against crude-based feedstocks. So we're expecting in the medium term the profitability of the Middle East petrochemical sector to return as the price of crude reestablishes itself into the $70 type range. For crude, what we've talked about is impact of projects being hit hard, future supply being delayed. Refining didn't really experience that. We have over 7 million barrels a day of refining capacity additions being categorized as firm. Those projects are largely unaffected by COVID-19. Delays are of the order of months rather than any particular cancellations. Pre-crisis, what we were looking at was the world having too much refining capacity. The impact of COVID-19 is to eliminate demand growth. We had 2 or 3 years of loss of demand growth, which means that the oversupply is very, very significant. What we're expecting is the global average utilization rate for the refining system to fall to levels not seen since the 1980s. This is really associated with very weak margins and the threat of rationalization. The chart on the right-hand side is showing the regional average refinery utilization forecast for Central Eastern Europe, the Mediterranean, Northwest Europe. The Mediterranean is going to be particularly challenged during this time, as we're expecting aggregate utilizations to be particularly low. So what this is doing is it's introducing the threat of a period of capacity rationalization. We think there are many assets that are assessed at a high risk of closure. The risk of closure is extended beyond Europe now and includes both North America and also Asia. In this assessment of those assets that are at risk, there are 2 factors. They need to be cash negative, so losing money in our forecast of the 2023-2024 time period, and also the other aspects around closure and rationalization are present. It comes down to things such as petrochemical integration, the need for investments, turnarounds, ownership structure, and social license to operate. In this chart on the left-hand side, we identified sites we believe are at high risk of closure. The one that is Total Grand Prix we identified has already been announced. We expect a number of others that are currently in maintenance to perhaps never return. In Asia, the threat of closure is particularly strong in Japan. This is because there are a number of sites that are weak in terms of refining capabilities and refining earnings. They're integrated also with petrochemical sites that are also weak. So we're looking at potentially 12 sites in Japan being likely closure candidates. It's not Japan alone. There are also sites in Malaysia, Pakistan, and a number of others. The US is also not immune. So we've got at least 400,000 barrels a day of risk of closure, in addition to the 400,000 barrels a day that has already been announced to be converted to renewable diesel. The industry needs to address rationalization very quickly if margins are to recover in the near term. If we think longer term and we think of the opportunity for the Middle East, what we're showing in this chart here is the supply-demand balances for key products within Asia. We're expecting Asia to remain deficit petrochemical feedstocks. That becomes a natural home for Middle East exports, LPG and naphtha. For middle distillates, we think Asia will remain balanced, surplus. Gasoline, we're expecting Asia to become a deficit. So there's the opportunity for Middle East players to satisfy those deficits of light feedstock, light distillates, naphtha and gasoline going forwards. In terms of new builds in Asia, what this does is it really emphasizes the need for refinery developments to be integrated in petrochemicals and so be self-sufficient in the provision of petrochemical feedstocks within those integrated sites. Chemicals now, high-level global views of chemicals. If we look at the left-hand side, what we can see actually is our expectation that petrochemical overall global utilization remains relatively low. Petrochemical performance in terms of margins has been far stronger than refining in 2020, as petrochemicals has not been hit so hard. However, we're expecting the period of weak profitability to remain as a result of oversupply through weak economic growth. This is particularly prevalent in the paraxylene markets, where we've seen significant capacity coming on in China through second generation integrated refining and chemical sites at a period when the demand for apparel and the fiber is low. But the key point to note on these is the chart on the left hand side, where what we're seeing is after 2025 global ethylene operating rates rise sharply, which means petrochemicals and the contribution of petrochemicals will start to become much more significant from that point forwards. So what we're showing here is our refining margins and our margins associated with sites that are being developed. 2020 is particularly challenging. We have some recovery in 2021, and if we look at the complex FCC refinery margin, the bottom blue line, what we think is margins do recover, but remain relatively modest for facilities in Asia. More sophisticated configurations, deep conversion with residue destruction do much better. Traditional integration with chemicals improve things a little bit further, but traditional integration of chemicals only provides a site yield of 10 to 15% of total outputs. Second generation integration, which we're seeing at Hengli and Rongshan, where the petrochemicals output is over 40% of the total product yield, we expect the profitability of those sites to return to attractive levels by the end of the decade. So the key aspect for new developments is the establishment of second generation refinery petrochemical integration. These investments are really to satisfy demand growth in Asia and the Middle East, and could be located in either place. This highlights a new offering that we've developed, where we've now modeled globally the 230 or so integrated refining sites that enables us to truly benchmark these sites and establish the key facets around the development of structurally attractive and sustainable integrated refinery chemical sites. That enables us to do cost of production analysis across those integrated facilities to understand competitive position, also overall economic competitive advantage, and understanding how these sites fit together and the impact they have on the broader world. The one thing we're very confident on is petrochemicals is a key theme within the refining sector, and significant refinery petrochemical integration will be a key driver to commercial success in a world that is recovering from COVID-19 and undergoing energy transition. So the key takeaways from this brief presentation is oil refining as a standalone business is entering a period of sustained pressure on its commercial viability. We expect those difficulties to ease, many of which are being driven by the pandemic. The upstream sector will recover more quickly through the loss of upstream projects that are within the non-OPEC region. So oil prices will recover far quicker than refining margins, as refining requires extensive rationalization to occur for margin recovery. However, east of Suez, Middle East and Asia is going to be the focal point for global oil demand growth, which makes Asia the global target for crude oil trade, will provide beneficial refining margins, particularly for highly sophisticated configurations, and further investment is needed in the longer term. And we see integrated refining petrochemical configurations are best suited to match that demand, though the larger they become, the bigger the threat that actually it also drives cannibalization and rationalization within the Atlantic basin because of the sheer scale of those investments. With that, I'd like to thank you for your time and attention. I'm Alan Gelder, VP, Refining, Chemical and Oil Markets for Wood Mackenzie. Thank you. Goodbye.